talk about what we can expect from the markets in the final month of the year. We want to bring in Seema Shah, Principal Asset Management Chief Global Strategist. Seema, it's great to have you back on the program. So talk to us just about how you think the setup looks like here for December. Is there any reason to think that we're not going to follow these past historical trends?
Hey, thanks for having me on. You're right, the seasonals for December do look certainly very strong, and there's no reason really at the moment to think that this month should be any different. Now, just focusing back on the fundamentals, though, the fundamentals are really supportive. What we've got is a backdrop of very strong economic growth. We have a Federal Reserve where, yes, there's question marks about how much they're going to cut, but they do have an easing bias, not a tightening bias. And then although we have some of the policy uncertainty ahead of us, generally speaking, a lot of the proposals really reinforce that narrative of US exceptionalism. So as we're looking out around the global space, how markets going to do around the world, the one thing that continues to stick out to us is really our US outperformance persisting through into 2025.
How much of the outlook for 2025 is really based on the U.S. economic growth continuing to remain above trend? And what most notably would that mean for portfolio positioning too?
Yeah, that is key. We can spend so much time thinking about what are the different tariffs, what are they going to play out? But the key thing that's really going to drive markets is whether or not earnings are strong. And for that, you need to have a solid macro backdrop. And as of today, the data is really telling us that the soft landing narrative is still very much in place. So that's going to be certainly very positive. From an asset allocation perspective, we also have to take into consideration that valuations are quite stretched, particularly in the US. There is still a lot of uncertainty globally. So it makes sense that at the same time as having an overweight possibly to US equities, that you do have some exposure to other markets around the world. Now, we wouldn't advocate necessarily for European markets at the moment because they have, I think, a quite concerning fundamental outlook. But other parts of the world, for example, Japan, India, some pockets of Asia, do look really attractive. There's also some space, certainly for credit markets. We do believe that the economic backdrop, as I said, is very constructive. So that should suggest some space for credit exposure. And then through all of this, as we look out to 2025, the key risk ahead for us is on inflation. Is inflation going to take off again? So from that perspective, it makes sense to have some kind of inflation sensitive assets, some kind of exposure there that can provide a little bit of inflation mitigation as we look out to next year.
Seema, even as we look ahead to the latter half of this week with the jobs report, I guess how big of a driving factor do you see that being in investor sentiment here in the coming weeks?
I think it is key for the near-term noise. One of the key things that people are trying to debate is how much is the Fed going to cut? There's even question marks whether or not the Fed is going to cut by 25 basis points in December or not. And one of the key influences of that is going to be the labor market report. But at the same time, one of the things that we have heard from Fed speakers in the last couple of weeks is that they have been emphasizing the distortions from weather-related disruptions, seasonality, which may be affecting labor market numbers. So we're going to look at it, but we're going to probably look through a lot of the volatility. We're really looking for a trend there. The other bit of data, though, which is probably more important, is going to be inflation. How is inflation performing? Is it starting to come down, or are we starting to see a resurgence? I think that's probably going to be the key dictating factor for what the Fed does in December.
How can we kind of gauge how far out the markets are looking based on the performance even in the consumer discretionary sector, considering as we're thinking about where there is still inflationary pressure, the consumer discretionary sector, at least for right now, at least over the kind of past month here, I think we had just seen it rise by 13.2% in November, best month since January 2023. So that would suggest that at least some investors out there are saying, hey, the consumer seems resilient and we're confident enough to look for a rebound or at least that resiliency to continue in the consumer despite pockets of some weakness.
I think that's really key. And, when we look at the data, we're also seeing clear consumer resiliency. And we're expecting that to persist, but we have to remember that there are pockets of weakness. So the strength that we're seeing is really around the medium to higher income households. Lower income households are starting to see some strengths. We're not too worried about it at this stage. Interest rate cuts should help. And overall, when we look to, what is the makeup, the medium and higher income households, they carry about 60 to 70% of consumer spending. So from that perspective, yes, consumer discretionary stocks should continue to perform well. And that is a forecast into next year. So there is some optimism about next year, but we just need to keep an eye. Does that lower income household, does their weakness start to feed through to the rest of the economy? And as I said, that's something that we need to keep a track of as we go into 2025.
Great points and insight. As always, Seema Shah, Principal Global, thank you so much for taking the time here.